here's the thing nobody tells you when you start researching real estate investing. The traditional advice, save up, buy a property, rent it out, repeat, assumes that you have the capital that most new investors don't have. It assumes that you qualify for a mortgage on your own. You can put down 20%, you can cover all the closing costs, and you have a ton of money for reserves. And that's what I call a capital catch-22. You need money to make money, but you can't make money until you have money. And this is super frustrating for a lot of people. But here's the thing. Joint ventures crack that wide open. And by the end of this lesson, you're going to see exactly how. Let's start with the basics. What is a joint venture? A joint venture, or a JV, is simply two or more people combining their resources to buy and manage an investment property together. That's it. Resources can mean money, mortgage qualification ability, time, skills, connections, or anything else you bring to the table that would be valuable. You pool what you have and you share what comes out. Now, I want to be clear about what a joint venture is not, because there's some confusion. A joint venture is not a corporation, and it doesn't have to involve a lot of complexity to set up. A joint venture is just specifically for one agreement, one property, one purpose. And this is what it could look like in real life. Example 1. Two friends, both who want to invest, but neither of them have enough for a full down payment or ability to get the mortgage alone. So together they pool their savings, get the mortgage, manage the property, and they split ownership 50-50 and both share in the returns. Example 2. You have the time and the organizational skills to manage the property, like screening the tenants, coordinating repairs, keeping the books, but you don't have the capital. So you partner with someone who has the money, but zero interest in actually running the property. They bring the cash, you bring the mortgage and the management, you both win. Example 3, a family member. Maybe your sister, parent, close friend. They qualify because they have strong income and good credit, and maybe they own properties already. You do all the legwork, finding the right property, building the team, handling the day-to-day, and they provide the down payment and mortgage. That's also a joint venture.